All right, we have about 100 people on, so thank you guys for joining. My name is James Eng. I'm a senior director at Old Capital based here in Dallas-Fort Worth. And today we're going to be talking about how to finance your next multifamily transaction. So we as the lender bring 75 to 80% of the purchase price at close. So think of us as your largest partner in the deal. And, today I'm going to take you through really 5 items. Number 1, loans available for multifamily properties. Number 2, recent transactions. Number 3, how to qualify for non-recourse financing. Number 4, top reasons to use us at Old Capital, and then how to connect with us. And so let me just jump in by talking a little bit about myself. I was born and raised in Houston, and then went to school at University of Texas in Austin and spent 10 years at GE Capital underwriting commercial real estate loans. And then the last 3 years I've been at Old Capital originating about $200 million in loans annually with a focus on multifamily. And so, I like to start a lot of conversations with beginning with the end in mind. And so I want to show this slide for a couple that will be highlighted later on in the webinar. And this is an example of an investor, Bonnie and Kerrys Staples, that I have worked with over the past 2 years, and they have purchased over 700 units in DFW. So they will be on the webinar later on in the presentation to discuss how they finance these properties and how it has changed their lives. So we'll talk to them a little bit later in the webinar. But I wanted to start off with a question. So if I handed you a 100-unit deal for $5 million, could you close it? So the first question would be, how would you finance it? What kind of loan could you qualify for? And then who would you need to be on your sponsorship team to qualify for this loan? So who else do you need to be on the team? And so during this webinar, we're really going to answer these questions so you're ready to take on your next acquisition. So whenever you look at a potential property, every lender is going to ask you these 3 questions. Number 1, is the property stabilized or distressed? And what the occupancy of the property? So is it 90% and it's a yield play, or is it more 40 or 50, 60% and more of a value play? And then the second question they're going to ask is, what is your experience with multifamily? And so are you, maybe have 5 to 10 units under your belt, or have you done, 100, 200 units already in the past? And then the third and final question really is, what is your net worth and liquidity? So understanding sort of your personal balance sheet, they're going to determine how much of a loan you can qualify for. So I wanted to start off with the 3 main types of loans that you as a multifamily investor can qualify for. And a majority of these loans are what first, second, third time investors use. And so these are what we're going to focus on tonight. So the first one is a bank loan, second one, Fannie Mae, and the third one, Freddie Mac. So on this slide, I'm going to highlight some of the differences, but then I'm also, in the next couple slides, I'm going to go through deal examples on how these loans were used by investors. And so on the bank loan side, let's start with the bank loan. The number 1 thing that is different compared to Fannie and Freddie is that this is a recourse loan. So you are personally liable for any shortfall. So if the bank forecloses on the loan and you are deficient and they can't sell it for more than the loan, you are personally responsible. So they could come after your personal assets on a deal like that. And so number 1, it's a recourse loan. Number 2, the amortization on bank loans is anywhere from 20 to 25 years. So while most people expect 30 years on single family, most commercial bank loans are 20 to 25 years. And then the last thing is prepayment. So on bank loans, it's really a step down prepayment typically. So in year 1, it might be 3%, then go to 2%, and then 1%. The second type of loan is Fannie Mae. So on a Fannie Mae loan, the main things to remember are that you can get up to 80%. So 80% loan to cost on Fannie Mae. So what that means is, in terms of cost, is purchase price plus the rehab in the loan. And then also the big thing with Fannie Mae is that you can set the interest rate for anywhere from 5, 7, 10, or 12 years. And once you set the interest rate, the only downside of that is that the prepayment penalty is a thing called yield maintenance. And so within yield maintenance, it is more expensive. So you're probably looking at closer to 10 to 20% of the loan early on in the term. And then it goes down as you get closer to the maturity of that loan. And the third loan that we're going to be talking about tonight is the Freddie Mac small balance loan. So similar to Fannie Mae, this is a non-recourse loan. You can fix the interest rate for 5, 7, or 10 years. This one, you can only get 80% of the purchase price, however. And so the rehab is not included in the loan, but this allows new investors to qualify for a non-recourse loan. So that's a key point, that Freddie Mac small balance, it allows you to get a non-recourse loan even if you are not an experienced investor. So that's sort of a summary of the three. And so now we're going to jump into the specific deal examples for each one of them. So these are recent transactions that I completed in the last 6 months. And so let's start off on recourse bank loan. So this, your occupancy can be below 90%. The rehab can be more than $5,000 a door, and it can be a first-time investor. So on a recourse bank loan, let's look at this deal on the right-hand side, Meadows Apartments. This was 32 units, and it was a first-time buyer. So they had no previous multifamily experience, and it was well occupied, but the property, in essence, it was run by a mom and pop. And so all the financials were written, handwritten notes, and the rent roll was, done on the back, of a napkin in essence. And so it was very difficult to get clean financials on this deal the way it was presented. So it could not go Fannie Mae or Freddie Mac. And so the borrower really decided to go with a recourse bank loan, because in 18 to 24 months, they were going to go and refinance this loan or sell the property. So when you go to sell a property on a recourse loan, the prepayment probably on this deal would be only 1% on the loan instead of a larger prepayment penalty. So that worked well on the first transaction, Meadows. The second transaction, Garden Gate, this was a property in Alvin, Texas, south of Houston. And the buyer actually started with another mortgage broker, and they went through Freddie Mac. But Freddie Mac looked at the deal. It had some low income restrictions and also some physical condition problems at the time, just because of the current ownership. And so it got declined by Freddie Mac, and the buyer came to us at Old Capital and said, can you close this deal in the next 30 days? And we took it to a regional bank and did a recourse bank loan where they ended up getting approval in the first week, and then getting third parties done the next week, and closing in less than 30 days. So on recourse bank loans, the key advantage is also speed. So, you can get deals done a lot quicker with recourse bank loans compared to Fannie and Freddie, where they're typically 45 or 60 days. So recourse bank loans, in summary, really work well for first-time investors. All right, let me check. Hold on one second.
You're good.
All right, so sorry about that, guys. We had just a technical delay. Can you guys hear me now? Okay, sorry about that. We had to switch over to mics. All right, so in summary, recourse bank loans work really well for first-time investors looking for a fixed interest rate, but then also flexible prepayment. And so if you're comfortable signing a personal guarantee, then this is a good fit for you on the recourse bank loan side. All right, next page or next slide is really on, so the second type of loan is your non-recourse Fannie Mae loans. And so on these, it's really for stabilized properties. They look for 90% occupancy for the last 90 days. And then also they want limited rehab and deferred maintenance. So really $5,000 per door is what they're looking for, or less. And so on Fannie Mae loans, you're fixing the interest rate for at least 5 years, and you can go up to 10 years on a lot of terms, even 12 years. So you're wanting to hold the property long-term on these transactions for Fannie Mae. and they want an experienced borrower. So somebody with at least 12 months of multifamily ownership experience on a deal of similar size. And so can you guys hear me now? All right, so sorry about that. We're having a little bit of technical issue, but let me just jump back in right here. All right, so on Fannie Mae loans, you're looking for stabilized occupancy. So let me go through two of these deals. So Wynwood, which is based here in Dallas, Texas, the buyer was actually out of state, and so they partnered with a local experienced multifamily investor to purchase this property. So they had experience with a less than 10 unit deal out in California, and they sold that deal, and then we're moving those 1031 funds to Dallas. And so they did not have experience with a deal this size, and so they actually partnered with another investor based in Dallas that had 150 to 200 units of experience, and that allowed them to qualify for Fannie Mae. So Fannie Mae is definitely a lot stricter on the borrower's experience, and so as you look at your sponsorship team, understanding who else can sign with you to strengthen that team will help you not only get a Fannie Mae loan, but then also qualify for the highest leverage and the most interest only. So the second deal, Toscana, was based property here in Bedford, which is a suburb of Dallas. And on this particular transaction, the purchase price was closer to $12 million and the rehab was $500,000. And on this deal, we were able to get 80% loan to cost. So not only 80% of the purchase price, but also 80% of the rehab in the loan. And so this gave the investor a $10 million loan, which in today's market is pretty rare, just because it's getting harder and harder to get up to that 80%. But when on this property, the net rental actually kept going up while we were under contract. So Fannie Mae loans work extremely well for experienced investors acquiring stabilized deals and then with limited rehab. So that deal only needed about $2,000 to $3,000 a door in rehab, and then the investor wanted to hold it long term. So that's really Fannie Mae loans in a nutshell. This is the highest leverage that you can receive on a multifamily property is Fannie Mae on a non-recourse basis. So the final loan type that we're going to talk about tonight is the non-recourse Freddie Mac loan. And so similar to Fannie, it needs to be stabilized for the last 90 days at 90%. They don't want a lot of rehab on the deal. And then you also have the ability as a new investor to use this loan. So the two deals on the right-hand side, Park at Woodland is the first deal that we're going to talk about. So this was actually an attorney in Houston that it was their first multifamily deal, but the property was in great shape. So you can see by the picture, brick exterior, hardy board siding, solar screens already done. The seller had put close to $10,000 a door into the property, and the investor wanted to syndicate the equity and stay non-recourse on the loan. And so the Freddie Mac small balance program worked really well for him. He was able to get 80% of the purchase price and then 3 years interest only on a 10-year deal. So that worked really well on that transaction. The second one was LaDonna Place. So this was actually in Wichita Falls, which is about 2 hours north of Dallas. And so that's considered a secondary market for Freddie Mac. And it was first time lead investors purchasing this property. And so Freddie Mac is a little bit more flexible on where the borrower is compared to the property. And so they had third-party property management, but since this deal was in a smaller market, they lowered the leverage to 75% and gave 1 year interest only. So depending on the size of the market, Freddie Mac does have, you might be at 75 versus 80%, but it is a great loan for investors looking at stabilized properties, and they do not roll the rehab into the loan on Freddie Mac small balance. So you're wanting to hold it long term, this is a great way, but then also you're going to have to raise any of the rehab out of your equity raise. So after reviewing sort of these three main types of loans, I wanted to talk about qualifying for non-recourse financing. So on a lot of deals, most people, they're used to signing recourse on a single family deal, but once they move up to commercial properties and you start doing $5, $10, $15 million loans, most people are not comfortable signing recourse. And so I wanted to touch on non-recourse financing and the four main aspects of qualifying for a deal on a Fannie or Freddie deal. So I like to think of it as a puzzle. You need four pieces of the puzzle to really put together a multifamily deal. Number one, net worth and liquidity. Number two, multifamily ownership experience. Number three, finding the property. And then number four, raising the equity. So every person in your sponsorship group should be bringing at least one of these items to the deal. So if they are not, there's really no reason for them to be in the transaction. And so as you start building your resume, think about which of these four items you are bringing to the deal, right? So the more items that you bring to the deal, the higher your sponsor compensation should be. So, at the beginning of the webinar, I asked this question, right? So if I handed you that 100 million or the 100 unit deal for $5 million, could you close it, right? And so when we look at a deal like that, let's assume 80% loan to value, so a $4 million loan. So on a $4 million loan, your net worth and liquidity needs to be equal to or greater than the loan amount, so $4 million net worth, and then $400,000 in post-close liquidity. So 10% of the loan amount needs to be in post-close liquidity from the key principals. So that's, as a group, you need at least $400,000 from everybody signing on the loan. So think about who would sign with you on your deal to meet these requirements. So most people cannot meet that requirement on their own, and especially as you scale up in size and you might be buying 150 or 200 units, that's going to be more and more difficult to qualify on your own. So really start thinking about who are the other investors that can sign with you. The second thing is multifamily experience. So Freddie Mac doesn't require it, but for Fannie Mae loans, if you're wanting the highest leverage, 80% loan to cost, this is one of the things that they're going to require. So you need someone with experience to sign with you. And the third is really the equity raise. So $1 million in equity needed to close this transaction. And so think about the investors that would invest, $50,000 is typically the minimum. So how much equity could you raise in 60 days? So you probably need at least 20 investors investing $50,000 to get to the minimum. But then also a lot of times you're going to have to reach out to a lot more than 20 people to get that $50,000. All right, this next slide is really some of the frequently asked questions that I've gotten sort of before this webinar and just in the last couple weeks. So I wanted to address them now. Number one is third-party reports. So what is the cost and time to complete? So on almost all these loans, you're going to have to do three reports: appraisal, engineering, and environmental. And these cost about $5,000 each and take anywhere from 10 to 15 business days. And then if the seller gives you a survey, sometimes that can work, but a lot of times if it's an older survey, Fannie or Freddie are going to need what's called an Alta survey, and that costs about $5,000 in 15 business days. All right, second question is, when do I receive approval and when do I lock the rate? So as interest rates have come up in the last month, people are getting a little bit more worried about locking their rate. And so let's start with the bank execution. So bank is quicker. So investment committee approval is typically within the first 2 weeks on the transaction. And then if it gets approved, it will be subject to the third parties. And so they'll give you an approval letter, but it'll say, it must appraise for this amount. It must have no environmental issues. And then you go out and actually do the reports. If they come back fine, then you can close. But the rate is locked. So right now on sort of recourse bank loans, you're looking at 5.25 on bank financing. And as the Fed raises their rates, every time they raise it 25 basis points, usually the banks are going to raise it 25 basis points. So throughout the year, we'll probably see increases, up to 550, 575 on those recourse bank loans. So on Fannie and Freddie, it's a little bit different. So they actually order the third-party reports first, and then once the lender has received those reports, and then also your due diligence from the borrower, also on net worth and liquidity, the sponsors' resumes, then they submit the entire deal to their loan committee for approval. So this process typically takes 30 to 45 days before you receive your loan approval. So once you receive your loan approval, then you can lock the rate on Fannie Mae. Freddie Mac, it's the same approval process, but they hold the rate for you up front. So if you sign an application today and it's at 5%, then they will hold that rate for you for 35 days. So as long as you submit the deal to Freddie Mac within 35 days, they will hold that rate for you. And so that takes a little bit of the pressure off. But once again, Freddie Mac is not going to roll in any rehab into their loan. So we touched on this in the last question, but number 3 is how long does it take to close a loan? So Fannie and Freddie, they're typically 45 to 60 days, and then the bank is 30 to 45 days. So when you're building in these timeframes into your offers, your LOIs, most people here in DFW, they're at 60 days. That's usually a standard timeline. And so it's only really if you run into a snag and you need someone to close a lot quicker, then a bank can come in 30 days and get it closed. But with Fannie and Freddie, it's definitely 45 to 60 days. And then number 4, closing costs. So closing costs are going to be pretty much fixed on the third-party reports. So the good rule of thumb is under $10 million, it's about 3% of the loan amount, and then over 10 million, it's 2% of the loan amount. So, these closing costs are really the loan origination fee, and then third parties such as appraisal, engineering, environmental, and then the legal and title. And so that was some of the frequently asked questions that we get on these types of loans. And I wanted to touch on next sort of what we do at Old Capital and how we help you through this process. So here on the right-hand side, the reason that people use us, the number 1 reason is execution certainty. So in 2017, Old Capital closed $750 million in loans. And on the right-hand side, you can see this is just a snapshot of the 30 loans that I closed, 30 of the 40 loans that I closed last year. So these are properties that really ranged from $1 million loan amount all the way up to $20 million in loan amount. And so as you can see, this is what we do. We really focus on BNC multifamily throughout DFW and throughout the nation. So the second one is really best loan terms and rates. So we meet with lenders every week. So as you can see on the right-hand side, whether it's Fannie Mae or Freddie Mac, our local bank, we constantly meet with these lenders to negotiate the best rates up front. And so these banks are going to see repeat business from us. And whereas you might close maybe 1 or 2 transactions a year with these banks, we close probably about 15 to 20 loans a month. And so these banks we're one of their biggest clients. And so they're really going to push for us in terms of loan proceeds, in terms of rate. And, once you get into underwriting of deals, you never know what's going to come up. And so that's number 2. Number 3 is really saving you time. So in DFW, a lot of deals, you're having to go hard with your earnest money day 1 with maybe 1 or 2% of the purchase price. And so it gets, you have 60 days from once you send in that earnest money. And so it's very difficult if you go bank to bank trying to find the right lender. And so we pick the right lender up front, so we know who can close after looking at the property's occupancy, and then also where the property is and the loan size that you're looking for, and then also sort of what your sponsorship team has in terms of experience. And so these last 2 reasons why people use us is experienced team. So I spent 10 years at GE Capital underwriting loans. And so I was sort of on the other side of the table looking at loans and really underwriting them and figuring out, where the bank could lose money on these deals. And so I know what the bank needs, when they need it and sort of why they need it. And so having that on your team is huge, because a lot of times on these deals, it's really the presentation of the information that is key, and how you present the information to the lender and the underwriter. And if they have any questions, being able to answer those questions in a quick manner so that you can keep the process moving and close within those 60 days. And the last reason that people use us is really inside information. So we do 1 out of every 3 BNC apartment loans here in DFW, and we have exposure and experience in all the Texas markets, and also started and nationwide. We do a lot of Fannie Mae and Freddie Mac business, and so a lot of people will reach out to us for a term sheet, and we can usually tell you who the previous seller was, who the lender is currently on the property, who manages the property, and anything about that general area. And so let me check one more time. Just, can you guys hear me on your end? Okay, thanks a lot. All right, so sorry, we're back now. And then, so I wanted to finish up sort of with 3 ways to connect with us. Number 1 is our podcast. So if you go on to iTunes and subscribe to our podcast, Old Capital Real Estate Investing Podcast, and we put out about 2 episodes a week on this podcast, and it's actually interviews with owners, with different lenders, vendors in the space. And so really, as you start building your team with legal teams, insurance, inspectors, this is a great way to really get started and start to learn about the apartment investing business. Second way is our Facebook page. So if you've been to our Facebook page, we have a video that comes out once a week that really talks about live stuff that's happening in terms of deals on the market, what people are seeing, and then also any type of live listing broker meetings or lunches that we hold in Dallas. This is a great way. Can you guys hear me now? There we go. So sorry about that. And then, so this last part really, so the Facebook page is a good way to connect with us. And then our last thing here is really our conference. So we hold this once a year. This year's theme is Get in the Game. So as a real estate investor, you're not an employee anymore. You're really your own boss. So it's up to you to make it happen. And so we are going to have a full day event at AT&T Stadium. And so there'll be listing brokers, lenders, property managers at this event. And then we're going to end with a keynote from Roger Staubach. And so there's a link here. You can find the link on our website and then also on Eventbrite. And we just recently added 2 sessions on Friday, September 14th. One is a listing broker open house from 8 a.m. to noon. So all the listing brokers in DFW are going to hold open houses. And then also we're going to have a syndication attorney come in and talk to us about raising equity the correct way. And so that will be on Friday, September 14th. And so you can register. I think the price right now is $299, and it will go up at June 1st. So if you have not registered for that event, that would you can click on the link and register that way. And so while you guys are putting in questions from all the material that we just went through, I wanted to bring on Bonnie Staples. So Bonnie Staples started investing in 2016 as a lead sponsor, and she has closed over 700 units in the last 2 years across 4 properties, totaling approximately $40 million in multifamily. And so can you hear me now?
Gotcha.
All right, so let's bring on Bonnie Staples now.
Thank you, James. It's a pleasure to be here, you guys, and it's been a great journey that we've been on. I partner with my husband, Kerrys Staples, and just a little bit about us. I was employed at Merrill Lynch, worked with investments with the stock market and stocks and bonds, mutual funds as such. And Kerry works at IBM, and we were trying to get going on real estate and diversify our portfolio in that direction. So we had started in single family, and we're really trying to go in that direction. And then we were introduced to multifamily and realized that we could go in the direction we were wanting to go into a lot quicker with multifamily. And we first of all, we sought out a mentor to help us do what we were going to do, because we had never done multifamily at all, of course, and so we didn't want to make costly mistakes. So we sought out a mentor, and once we started with our mentor, we started looking for deals, hunting for deals, but also at the same time, we were starting to be passive investors in multifamily deals. So with that, even though we were not the lead sponsors on it, we were actually gaining a lot of experience from the information that we received from the current sponsors. We did find our first deal was Casa Flores, and this deal actually, we did not win this deal the first time around. And the story behind this is because of our relationship with our mentor. When the deal fell through with the first initial buyers, the broker knew of our mentor and knew our group and knew that we were a group that would close the deal, and came back to me and said, "Bonnie, are you still interested in Casa Flores?" And I said, "Yes, I am." But we had to negotiate the price down a little bit, and so that was an awesome situation. We closed that one February in 2016. We did rebrand it to Los Robles, and we actually sold that deal after 19 months as a home run for our investors. But on that deal, we used Old Capital, of course, to do our financing. And the unique thing about Old Capital is not only are they your mortgage broker, but they're also out there making sure they're fitting your property and your position with the right product out there. So we had a very unique product with the financing that we received on this one, which was a 7/6 ARM, which also gave us the flexibility to get out of the property in 19 months with just a very small prepayment penalty on this one. So it made it very attractive to be able to fulfill our business plan and make it a home run for everybody. And on this deal, we actually had, and James talked about this as building your team, we actually had two key principals that actually joined us on this deal, because Kerry and I had not had any multifamily experience prior to this. And so we brought on someone that did have ownership in multifamily before, so that was our experience. We were able to use his experience on our resume to close that deal. So we had 2 KPs on that deal, and we also had 17 total investors on this deal. We syndicate our deal, so it's sort of like group purchasing, so you don't have to come to the table with all the money to close the deal. And then the second deal, well, I'll tell you just in between that. So we closed in February of 2016 to purchase Casa Flores, rebranded it to Los Robles. Well, in April of 2016, I actually retired from my career at Merrill Lynch, 33 years, and began doing multifamily full time. Although we have a third property management company that manages our properties, there's still some time involved. Plus, we also wanted to allow me to have time to search for our next acquisition. And so our next acquisition was Villa del Sol, which is a 255 unit, which we actually closed it exactly 1 year, within 1 day of 1 year of Casa Flores. And we actually rebranded this one to Bella Vita. And as you can see, it looks very beautiful right now. And this one, we also received a Fannie Mae loan on this one, again through Old Capital, non-recourse loan with 12-year term on it. And we received 1 year interest only on this. And we had 2 key principals on this one with us, and then also 50 investors that invested in Bella Vita, and this one actually is already paying out dividends to our investors. We pay about 11% annualized returns on that one on a monthly basis. And just going back up to Los Robles, that one we actually sold in 19 months and paid out about 189% total return to the investors. So we had a lot of happy investors there. And then the next one that we closed on was in January of 2018, which was Fair Meadows. That's 200 unit. And that one, we also received a Fannie Mae loan with 1 year interest only, non-recourse loan, 12-year term. And we have actually 4 key principles on that. And again, as James talked about, your key principles along with us, makes up what the lenders are looking for as far as your net worth and liquidity. So usually the larger the deal, the more KPs you might need to have, or key principles you may need to have to be able to make up that qualification for your lenders. And we have about 60 investors on that deal, and we will be rebranding that one to Meadows on Merrill. And then the latest one we closed on was Spanish Timbers, and this one is very unique. Kerry and I were not in the market to purchase, but because we've purchased the 3 deals, there was there was a broker that said, Bonnie, we really want you guys to look at this because it's close to Bella Vita, which we own, and he really felt like it made sense for us to look at it. So we did go and look at it, and decided that yes, it was definitely worth our time and efforts to do this. It's 160 units. We just closed a couple of weeks ago on this one. We also received Fannie Mae non-recourse loan on this one as well. And this one we actually received 3 years interest only. And just talking about interest only a little bit, again, I believe that comes down to your experience and the property as well. And so with Los Robles or Casa Flores, we received 0 interest only because we had no experience in multifamily. And then as we gained more experience, our interest only has gone up since that time. So, and on this one, we actually have 5 key principles on this, and this actually helps, having the key principles also helps the key principals build their resume as well. So we like to be able to help as many people as possible. And we have about 50 investors on that. And then the good news with Spanish Timbers is once we closed on Spanish Timbers, then Kerry retired last Wednesday, a week ago. And so he is now retired from IBM, his 18-year career with IBM, and now he will be full-time with me, helping me, and I'm super excited to have him on the team. And again, we've done all of the financing with Old Capital, and James Eng actually has been our go-to person, and I like to tease him and tell him that I don't believe that he ever even sleeps, because he's there when you need him. And quite honestly, James keeps you on track. He keeps you ahead of the game, so that when the lender's asking for something, I mean, he's already warned you of what you're going to need, and so there's never a panic situation, because he always keeps you ahead of and in line of what is needed. And so it's we've had total smooth closings every time. As a matter of fact, Spanish Timbers actually closed earlier than projected, and we're very thankful for Old Capital, and we're very grateful that we've moved into the multifamily world. It's been life-changing for us. And if you want to learn any more about what we're doing or what we're up to, you can reach out to me at bonniestaples.mf@gmail.com. And I believe that that'll be on the slides that you can see as well. But you can always reach out to me. Let me know that you heard from me on the Old Capital website webcast, and I'd love to hear from you.
Great, thank you, Bonnie. So we're gonna transition now into some of the Q&A. And so if you have any questions, you can type them in the chat box. And so I think we've got quite a few questions. So let me just start at the top and hit the ones that are most applicable to investors. So give me a second here. Okay, so the first question is, what is the minimum occupancy rate for agency financing? And is that physical or economic occupancy? So on that question, it really is 90% physical, and then they want 85% economic. So that is the minimum. Let me go to the next question here. Okay. Okay, a couple people asked if the slides will be available later. So these slides I will send out to everybody who is registered for the event. So these will go out tomorrow morning. Next question is, what is a step-down prepayment? So that typically is on Freddie Mac small balance, and also it's on recourse bank loans. So they typically start on recourse bank loans at 5% and then go down 5, 4, 3, 2, 1. So your prepayment is based off of the loan amount. So for example, if it's $1 million loan and it was a 5% in year one, it'd be $50,000, and then step down to 4% in year two. So depending on what year you pay off that loan, that would be the prepayment penalty. So we got that one. Okay, so Sarah had a question on if you start with a bank loan for 2 years while you're renovating the property, and then can you apply for the Fannie Mae loan once the property is stabilized? And that is correct. So that is what a lot of people do when you go through a, let's say the property is 75 to 80% occupied today, or the property has very low rents, and you want to go in and renovate the property. The best way sometimes is with that bank loan. And then once you bring the property up to 90% occupancy, and then you can refinance it with Fannie or Freddie or sell the property. So that's actually a very good question. So Tony had a question on, does serving as a KP on a multifamily deal qualify as multifamily ownership experience? And yes, so if you sign on a Fannie Mae or Freddie Mac loan and then go on to buy your own deal, then yes, that will qualify as multifamily ownership experience. The one thing to be careful about is if you sign on, let's say, a 30-unit deal, and then you go and try to buy, let's say, a 150 to 200-unit deal, they will not consider that enough experience. So while you do have multifamily ownership experience, they really want you to work on a larger transaction. And so make sure if you're going to sign on a loan that it's a larger property loan, because then that will be easily translatable to your own deal. All right. All right, this question is around interest only. And so a lot of people are asking for a little bit more interest only in today's market. So on recourse loans, you're typically looking at 1 year interest only. On Fannie Mae, you're looking at 1 to 3 years. And then Freddie Mac, you're looking 1 to 5 years. And so on those interest only loans, people are really asking for interest only because it helps your cash on cash to investors as you're only paying interest. And then especially when you're rehabbing loans, when you're rehabbing properties, the occupancy could dip on a property. And so that allows you to maintain the cash flow and maintain the debt service. And so even though when you go in and rehab the units, your occupancy might drop from 90% to 85%, having interest only at the beginning of the loan allows you to service your debt still and still be able to make your payments. And so they typically like to give interest only while you are rehabbing the deal. And then once you're finished rehabbing, it starts amortizing. So we had a couple questions on investors or people buying outside of Texas, and we do work with investors outside of Texas. So we do all the states in the U.S., but our focus really is on Fannie Mae and Freddie Mac outside of the U.S. So if the property is above $1 million in loan amount, and then also you qualify as an owner, then we can help you on those types of transactions. Okay, this is a question around Freddie Mac. It says, what's the prepayment on Freddie Mac? So on Freddie Mac, you actually have two choices. You can do yield maintenance, but most of the deals on Freddie Mac are quoted as step down. So we talked about step down prepayment. So on Freddie Mac, it's typically on a 5-year deal, it'll be 5, 4, 3, 2, 1. And on Freddie Mac, that's typically what's considered step down, and that's pretty standard. And yes, the question is, are both Fannie and Freddie 30-year amortization? So yes, on Fannie and Freddie, you typically get at least 1 year interest only, and then it will start on 30-year amortization. Okay, so somebody asked about the net worth and liquidity requirements. So this is when you start looking at your net worth and liquidity, they are going to ask you to put together a personal financial statement. And at that point, they are going to validate the assumptions in terms of your REO and your liquidity. But they are essentially trusting you that your net worth is correct and you're signing and attesting to that. But for the liquidity, they're going to ask for the last 2 months of bank statements. So any checking, savings, or marketable securities accounts that are non-retirement, they will be asking for those bank statements, the actual bank statements for the last 2 months. So you will have to provide those to prove your liquidity for all the key principals. Okay. So Jimmy asked the question around serving as a KP versus just an investor. So, Bonnie talked about this on her transactions. The KP is actually signing as a loan guarantor, and an investor is really just investing as a limited partner. So, for example, there might be some people that, sign on the loan and are a guarantor, and those people, their net worth and liquidity in totality for the whole group is what the lender is gonna look at, and they're gonna run credit on all those people and ask for bank statements for all those KPs. Whereas an investor, as a limited partner, you could be, a non-US citizen, you could be outside the US. They don't ask for really anything of the limited partners. You're gonna write a check as a limited partner, and then the KPs and the general partner and lead investor are gonna be signing on the loan. Okay, Sarah had a question on growing. So she has 24 units as an independent owner right now, and then she's asking, how could I qualify for 48 units and then 48 units to 100 units? And so, Sarah, there's a couple ways. One is if you want to continue to own your properties on your own, then going from 24 to 48 is a good jump, and even 24 to 100 might be doable. The main thing is really your net worth and liquidity. So the things that independent rental owners run into is a lot of times once they put that down payment, so let's say 100 units in DFW, that might go for $5 million or more. And so you're gonna have to put $1 million down and then also have 400,000 in post-close liquidity. So that might be the hardest thing about being an independent rental owner and qualifying for these loans is that post-close liquidity. All right, let's see. Okay. So James had a question around the typical amount required in cash after closing. And so this is really around your working capital. And so depending on the size of the deal and then the amount of rehab that you're doing on a transaction, that's going to determine your working capital. So, I mean, if your deal is, let's say, a $5 million deal and a $4 million loan, the bank doesn't actually require you to have a certain amount in terms of number of months of debt service, like you asked. But if you're going to do, let's say, $500,000 in rehab, then you're going to have to do that work and then ask for reimbursement from the lender. And so a lot of times people will have close to 100 or 150,000 in working capital so that they can do the rehab, and then as they're waiting for reimbursement from the lender, then they keep revolving that working capital over and over again until all the rehab is done. So that's typically the best way, and it's always obviously better to have a little bit more cash on hand in that working capital number if you can. So someone had a question around the liquidity again. So you remember Fannie Mae is asking for 10% of the loan amount in liquidity post-close. And so they are not really concerned about your equity raise as part of that liquidity. The liquidity is really what do the KPs already have in liquidity. So if the loan amount is that $4 million loan that we had, then you're going to need 400,000 from your KPs in bank statements to be shown. So it doesn't matter if you raise $1 million plus another 400,000, that's not going to be enough for the post-close liquidity. So you can't raise the liquidity. So someone asked around, Andrew asked about the smallest deal that Old Capital would look at. So in Texas, we can look at smaller loans under $1 million, but that'll be a recourse bank loan. But outside of Texas, we're really going to be looking at Fannie and Freddie, and their minimum loan amount is $1 million. So it's not really the number of units, it's really dollar amount. So $1 million loan or higher. Let's see. And yeah, I mean, a couple people had questions around out-of-state investors. So really, we do properties all over Texas, but out-of-state, we really focus on Fannie and Freddie. All right, we have a lot more questions, but what I'm going to do is I'm going to basically download all the questions and I'll put it in a FAQ for the webinar and then send it out to everybody who registered. So I wanted to wrap up just with some next steps here. Number one, my thing is a big thing is education, right? So subscribe to the podcast, like our Facebook page, register for the conference, and then we're going to have a webinar, Multifamily 102, so Multifamily Financing 102 on June 20th. And this is going to get into a lot of the nuances of Fannie and Freddie around the green program, around assumptions and supplemental loans, and then also how to underwrite these transactions and how the bank looks at underwriting these deals. So let me see. So these are some of the topics that we're going to cover in a month from today. So underwriting the deal, qualifying for green, special situations where you need a Fannie Mae waiver, what markets are pre-review for Fannie Mae, and then also prepayment penalties, loan assumptions, and supplemental loans. So definitely, if you need to watch this one again before we jump into 102, definitely do that. We'll put out a recording of this 101 and join us for 102. And then the second thing is really, completing your personal financial statement and figuring out sort of where you are today and what you need, what goals do you have in terms of multifamily financing, and really sitting down with us here at Old Capital and figuring out, what your next steps should be based on your financial situation. And the last couple things here, depending on where you're looking at deals, I would start underwriting new listings and understanding what rents are in those submarkets, and then start making offers on deals, right? So ask us for a debt term sheet, start putting together your sponsorship group, and then start building your proof of funds so that, loan listing brokers will take you seriously because you actually have, a loan sheet and a sponsorship group that can close. And the fifth thing really is closing your first deal. So on a lot of deals, you look at a lot of deals, but going from 0 to 1 on a deal and closing that first one is just a huge mountain that people need to overcome. And then once you close that first deal, it just really changes a lot of things, because now instead of you hunting for listing brokers, they start looking towards you and start bringing you offers. So thank you guys for coming. We're up at 8 o'clock today, so I just want to respect everyone's time. If you have any questions, you can reach me at my email here, jeng@oldcapitallending.com, or you can call me at 214-300-5035. Thank you very much.